For only the third time in the last 12 months, the S&P 500 has logged 2 straight days of at least 80% breadth. This is happening as a very popular sentiment index just hit extreme greed for the first time in a few months as well. We're going to look at both of these and decide where exactly we are in the market with a few weeks left to go before the presidential election. So we have a conundrum, right? A strong breadth and short-term stretch condition for the S&P 500. And if it sounds like we've gone through this before, it's because we have. And this is what happens when you're in a long-term uptrend. Some things that seem to be suggesting a mean reverting move is coming just don't play out as we think they should. And sometimes we have to wait for a pullback to occur before suggesting that something is actually too extended to continue. So let's look at this more closely. So 2 straight 80% breadth days. Here they are on the chart. So it may not seem like this is a big deal, but of course it is. It's only happened 2 other times over the last 12 months. And we can go all the way back to the very beginning stages for the first time it occurred. And so again, just a few days after the low from October 2023 was in this happened, and that just slungshot the market higher for a number of months. We know that we had the this wide breadth thrust indicator hit and a few others at the same time. And we know what happened after that. However, we had to wait all the way until the middle of July, just a few months ago, for that to occur again. And as we know, this was just a few days before the market topped. So of course, the notion here is, well, that just means that it was a blow-off top, and when things are too good to be true, that means that they are. Yes, that could definitely be the case, especially looking at now. We know that this past instance here happened as the market was making new highs again. So we compare the last 2 days and what the market looks like from a chart perspective to the last 2 instances. Needless to say, it looks a lot more similar to July as opposed to last November. However, it's not apples to apples, because if you look at here down at the 14-day RSI, you may know that we still haven't had an overbought reading since July. And of course, that means the last time we had a 14-day RSI above 70 was right before the market topped here. And one of the major reasons is because of the leadership. We know that on the way up here from June into July, it was led in a very material way by technology. And all large cap growth got to the point where it just was too good to be true, especially in front of earnings. When those companies started to report, not many of them were received in a very welcome way. And so along the way here, the market was overbought for over a month straight, as opposed to right now, which it hasn't been, because even though technology has come back very well since the August low, many other areas have been doing better. They just don't have the influence to pull the S&P 500 momentum back up higher, as we would see if many of the other biggest names, most influential ones, were making new all-time highs in unison like they were back here. And so we're still dealing with a pretty stretched nature of the market though, right? And so compared to its advanced decline line, we can see that both of them have made new all-time highs now as well. And so in the last video, we talked about how the cumulative advanced decline line was not making a new high, but probably would get there if we just had a few more days of strong breadth, which of course we have gotten. Now looking at what happened back here, the beginning stages of the rally, right? The advanced decline line and the S&P 500 look pretty similar, both off their lows but nowhere near their highs. But again, because of how so many stocks were doing well all on the way, this continued higher. That changed a bit, again, as things came back from the March to April sell-off, because eventually technology took hold, which allowed the S&P to break out to a new high back in early May, where the S&P 500's advanced decline line didn't really get there until the middle of July. At that point, technology started to pull back substantially, of course, which hit the S&P 500, didn't make a new high again until early September, where the advanced decline line itself, because so many other areas were doing better, was able to continuously edge higher all along the way. So that kept the foundation strong as well. And so from a sentiment perspective, when you have good price action, what does that do? Makes people happy, sentiment expands to the point where sometimes it gets too extreme to continue. Just the normal course of action, the pendulum swings from one side to the other. And so, for the first time since September 30th, the CNN Fear and Greed Index is now at extreme greed. Now, before that, the last time it happened was way back in March. And we can see this pretty clearly on the chart here. This is a chart from Macro. Micro do a good job of overlaying the S&P 500 here in red with the Fear and Greed Index in blue. So we can see that it was percolating kind of near extreme greed for a few weeks as the market continued higher, but actually just hit it just now for the first time again since September 30th. But before that, we go all the way back to March, where, of course, a few weeks later, the market rolled over. But anytime you look at something extreme, whether it's an index like this or a indicator, you look back and always talk about the last time it occurred. But invariably, that always marks a top, because if it didn't happen in a few months after that, we know that was an extreme. But what we should really be talking about is the first time it happened during that period. And the first time we had an extreme greed reading of this entire run was December. And from December all the way through March, we had at least one extreme greed reading, mostly maybe more than that, per month. So December, January, February, March, the whole way during the time when the market was really at its best in terms of rallying in a very non-volatile way. We can see that here with the pullbacks, of course, being very, very small. And so looking at that more closely, from the end of January all the way to the beginning of March, these are 28 trading days. You can see how many of them were extreme greed. 12 of them overall, which means that 16 were greed. And so like we like to see with any kind of oscillator with the market moving higher, it goes in between overbought and say the midpoint and continues higher. So again, this is what's been going on with sentiment. So we know just getting to extreme greed one particular day, just one day so far, after not being there for so long, doesn't really mean much. It's about what the market does with it going forward. And so needless to say, there are some indications that we're a short-term stretch. Now, we won't look at that, the short-term RSI this time, but that one still is, of course, near overbought as well. Another one that we find very helpful, just the Bollinger Bands. And an iteration of that is the %B indicator, which just measures in the particular index, in particular for right now, the S&P 500 versus the upper band or lower band with a number above 1, meaning that it's extended, obviously above the index or above the upper band, and the higher that it gets, the more extreme it is. And as we can tell here, it just hit 109 yesterday, and that's pretty extreme compared to what we've seen over the last year and a half or so. And so as we show each one of these along the way, the ones highlighted in red, of course, mark the times when that nailed the tops, both right before the spring pullback and again right before the summer pullback. But the other times, just another indication of a market that was able to continue to rise, right? Even though it was getting close to the upper band and riding it. And I think that the best example of that occurred once more at the beginning stages of the rally from late 2023 to early stages of 2024, where it just oscillated in between that 20-day moving average, which is measured above, of course, and then the upper band, which is 2 standard deviations above the 20-day. And so when that stopped happening, of course, the spring pullback emerged. Another thing to pay attention to here is the width of the bands, right? As you have lower two-way volatility, right? A lower frequency of 1% moves, that's going to shrink, which it, of course, has. From a very high, or the width was in an extreme here, not surprisingly, with the August pullback and big snapback. And right now, that it's very narrow. So we can, in essence, get a pullback, which takes us back down to lower band and really have nothing materially affected with the S&P's technical state, because that will only be, say, a 2 or 3% pullback at that stage. And so we're also at some points suggesting weekly extremes as well. And so here's one way to look at it. This is just looking at all the weekly winning streaks going back to 2021, riding a 5-week winning streak now that is tied for the longest with 2 other times. We had 5 in 2024, the very beginning stages of the year, January, and then coming back from the spring pullback as well. Now, what's even more interesting about this is looking at the 5-week rate of change. Just measuring weekly closes over the last 5 weeks, it got to 7.5% after last week. And that lines up, interestingly enough, with the 5-week rate of change during those previous 5-week winning streaks as well. Didn't get much more than that. And as we can tell, it didn't really wreck the uptrend at all, but it should tell us probably not to expect this type of move over the ensuing 5 weeks, right? The market can still rally. Now, the other part of it is only 3 other times did the 5-week rate of change get much higher than the 7.5%. That was twice in 2022 and once in 2023. Now, we know that the first one was a result of a fierce bear market rally in the summer there, and it was quickly faded and we got new lows. The other 2 times, though, both occurred at major low points in October 2022 and then again October 2023, which then kickstarted some substantial rallies both times. Of course, we're not near a major low right now, so it's not exactly comparable, but we did have that quick 10% pullback in August and then another relatively smaller pullback in September, which has kickstarted this. But at some point, again, when this fades, it's all about what the market does in response to it, right? Because we know that some of the biggest pullbacks have occurred after the market's made new highs. And we can see that here if we overlay this with this trading channel, which has captured the price action very well. This is the October 2022 low, right? This is the entire 2-year bull market where not much time has spent above or below the lower and upper thresholds of this channel. And the most important part from our perspective is knowing that the biggest pullbacks along the way have all started after the index has gotten to or sometimes through the upper band. Not quite there yet, but of course, getting closer to it once more. Something else we'll keep in mind as you get through the next few weeks and months to conclude the year. And so weekly bullish patterns have been, of course, a major story as well. And these are the biggest ones, the ones that we can frame on a weekly basis. So a few common characteristics here is that, of course, they had to form, which is good, meaning that the volatility that has arrived ended up being parts of bullish patterns. We got the breakouts, of course, and those breakouts had immediate follow through, which allowed the S&P, to extend, hit its target without having those breakout zones being negated. So that brings us to right now, getting a better extension over the last few days or so, but still relatively close to the breakout zone. And here is a clearer picture of that. This is the current one we just looked at on the weekly chart. This is on the daily. We have a pretty good target here, 61.80 still. And we know that the price action hasn't been too strong, just 1% gain and 1% loss since breaking out in the middle of December. So, pulling, getting further from the breakout zone, now about, say, 3% above it. So it could withstand more volatility and still be there. But of course, we want to continue to see this extend to increase that cushion along the way. And if this is going to get achieved, we first have to get the other upside target, which was triggered through that breakout through 56.50, and that is a target of 5,900, what the S&P got, within, say, 60 basis points of at its high on Monday. And so overall, there are still 3 bullish patterns in play, which now has been with us for almost a month. We got the breakout again on September 19th, and still waiting for these to get acquired. So we can be patient, though, as we've spoken about before. The most important thing is continuing to have bullish patterns in play, meaning that we're above a breakout zone. That breakout zone hasn't been violated, so we have an upside target to shoot for. Obviously, things change if those get violated. It also changes once we achieve upside targets and we don't have them with us anymore. That just means we need another digestive phase to occur. That happened right before the spring pullback, that happened right before the summer pullback. So if and when these targets get acquired and we're still extended or even more so, and we still have extreme greed, that's when maybe we could get cautious. But until that point, still waiting for these bullish patterns to get acquired, and most importantly, having those breakout zones be respected. That's what we have for today. Don't forget to check out these videos and subscribe, and talk to you next time. Thank you.